Hey everybody, in today's video we're talking about how does your TRS or PERS withdrawals affect your taxes. So this question, again, like always, comes directly from our email list or our subscribers. And this is one of the top questions that we keep getting is how does withdrawals from my TRS or PERS impact my taxes? So let's get right to it. So remember that your TRS or PERS accounts, right, we're talking specifically about Plan 3 here, is our pre-tax accounts, meaning that we have not paid taxes on any of the money yet. We've been deferring. We've been saying, hey, IRS, I'm going to put money in here. Can you defer it and I'll pay you later? So but we've been pushing it off and we're really procrastinating paying taxes into a later date, kind of in hopes that in the future, maybe I'll be in a lower tax rate or tax bracket and I may come out ahead then. So because we've done this, whether by choice or by force, that's kind of the situation you're looking at. Every dollar that comes out of there has to be taxed still. So when I take money out, I'm gonna have to pay taxes at what rate? Depends on what tax situation you're in. It could be you, if you're in the 10% bracket, you're gonna pay in that bracket up to the limit, or you're gonna pay in the 12, 22, 24, or so be it. So you're gonna have to pay taxes based on whatever income bracket you find yourself in a given year. Remember that tax code's written in pencil, so the current brackets aren't gonna stay there forever. They're likely to change multiple times over the course of your lifetime. Whatever the rates are at, you're going to be forced to pay it at those rates. Now, keep in mind that just because you're in the 20% tax bracket doesn't mean that every dollar you make is taxed at 22%. The US has a marginal tax bracket system. So for instance, married couples, the first $19,000 and change, they're taxed at 10%. And then up until you make, 82,000 or so, you're taxed in the 12% bracket and so on and so forth. So hypothetically, to make things easy, if you had $80,000 of income and you were in the 12% bracket, and the cutoff for the jump up step was $85,000, and you took out $10,000 from your TRS or PERS 3 account, you would have $80,000 of income plus the $10,000 of withdrawals. That's $90,000 of income. You cross the $85,000 threshold. You're now in the 22% bracket. Doesn't mean every dollar is taxed 22%, just the amount over the threshold. So every dollar between 85 and 90, $5,000 will be taxed 22%. The rest of the money is going to be taxed at whatever brackets those ones fall into. All right, so we have a marginal rate, and a lot of times we have an effective rate. How much of my money was actually taxed, what percentage was that? So you want to look at your effective rate to see kind of what you're actually paying per year. So when you're taking withdrawals, remember that you're going to pay tax on every bit of this. Now, if you're thinking about paying off your mortgage, another question we get a lot, what if I just took out $150,000 or $200,000 from my Plan 3 account and just paid off my mortgage with it? Well, every dollar is going to be taxed. So if you still owe $200,000 in your mortgage and you're thinking, hey, I'm going to take $200,000, send over there and be good, that's not going to work because you still haven't paid tax on it yet. You probably have to pull something like $240,000, $250,000 to cover all the taxes, right? So I pull out $250,000, I have to send $50,000 of that straight to the IRS. The $200,000 then go and pay off the mortgage. Now look, when you think, why do I want to pay off the mortgage? Yes, you're going to save on the monthly mortgage payment, but really you're really trying to save on the interest rate. Now, if you have one of those mortgage rates that are 2, 3, 4%, heck, even if it's one of those new ones at 6 or 7%, chances are there's really no good case or reason why it would make sense taking money out and paying taxes at 22, 24, 28 or higher on this money just to save 3, 4, 6, or even 7% and mortgage payments. Plus, in addition to that, you lose the potential growth opportunity that could have generated for you, which could be several $100,000 when you think of it. So this is one of those costly mistakes that we get all the time, and unfortunately we see from time to time that people have done, and then it's always something that they look back and regret on. We've seen people go broke within 3 years of retirement just because they did this. They understand the ramifications of long-term savings. Chances are you're going to need this money in the future, whether it be for something fun like vacations, buying RVs or cars, or something not fun like healthcare or taxes. You're going to need this money for something in the future. So you want to preserve it for as much as possible. Paying off your mortgage, typically not one of the best moves you want to make when pulling money from pre-tax dollars. Now, a couple other hidden things you're going to see other than taxes is depending on your withdrawal levels, because it increases our taxable income, you may be subject to paying more taxes on your Social Security as well as your Medicare premiums. So Medicare has a couple of thresholds, income thresholds, that if you hit it, you automatically have to start paying more for your Medicare premium. This affects both you and your spouse. So for example, if you cross over $182,000 of taxable income, you automatically have to pay $60 more per month per person for your medical benefits. Now this can be as high as an extra $400 per month, depending on how you go in income. So you want to look for the Medicare threshold for income limits. Second thing, when it comes to Social Security, they base how much of your Social Security gets subject to taxes off something called a provisional income. Basically, it's a summary of half Social Security plus all of your income sources, rental properties, W-2, 1090 incomes, retirement withdrawals, plus any tax-exempt interest, CDs or mutual or municipal bonds. Those all get added in there. It's called your provisional income. Taking money out of your retirement accounts automatically increase your provisional income, automatically makes you pay more in Social Security taxes. So for an example, if we had a $10,000 withdrawal from a retirement account, that automatically increases my provisional income by $10,000. And really what it means is an additional $10,000 in my Social Security is now being subject to taxes. So not only do you have to pay federal taxes on the $10,000, which say if you're in the 20% bracket, I pull $10,000 out, I owe 20%. So I have to withhold $2,000. Now $10,000 of my Social Security becomes subject to tax. I have to pay taxes on that money. So that could be another 20% you owe. So really that $10,000 of withdrawals could end up costing you $4,000, which is equivalent to about a 40% tax rate. So that's something you want to keep in mind. All right, I'll see you guys next week. Remember that your future depends on what you do today.